Good afternoon. In the final session of today's conference, we're going to be taking a look at some of the specifics of the one topic that's been dominating the entire conference, or for that matter, the entire year. There are many possible links between COVID and the future of the covered bond market. Many of them have been touched on in the previous panels, and all of them are very important. I'd like now to look down into the details of some of those, whether they be credit-related or market structure-specific topics, with the help of a distinguished panel. Let me briefly introduce them to you. Arnaud-Guilhem Lamy is Strategy Head for Euro Aggregate Products at BNP Asset Management and a regular speaker at Euromoney events. In addition to his strategic responsibilities, he's the specialist for socially responsible investments. David Knutson is joining us from New York, where he's the head of credit research for the Americas at Schroders, with a leadership responsibility for researchers covering areas as diverse as emerging markets, municipalities, and investment-grade product. Jacek Kubas works in the local currency and capital markets team at the EBRD, where he's long been a champion of covered bonds, helping to reform and introduce covered bond markets in many of the EBRD's countries of operation in Central and Eastern Europe and beyond. Morten Keil is head of all four of Nordea's covered bond issuers in the four Nordic countries, with responsibilities covering both the local currency markets and the euro markets. And last but not least, Boudewijn is the head of flow ABS and covered bond structuring at BNP. He's a very familiar face in the covered bond market. In addition to his role at BNP, he has a spare job in his spare time as chairman of the European Covered Bond Council. Thanks everybody for joining me. Can I please kick off with the big credit issue in the wake of the COVID epidemic? Arnaud-Guilhem, how concerned are you about the credit of the underlying mortgage assets in the light of the pandemic?
So thanks, Richard. With the COVID crisis, several issues has arisen within the mortgage covered bonds. So both residential and commercial mortgage pools are impacted, but I think the challenges are very different between these two types of loans. So if we start with the residential mortgages, I think you have two main impacts on the potential performances of the loans. So the short-term impact is with the payment moratoria, and the longer-term impact is, of course, with the drop on growth, increase in employment, and ultimately the default on mortgages. But let's quickly focus on the payment moratoria. So several countries in Europe have introduced payment holidays on mortgages to private individuals and corporates. And within the biggest covered bond countries, only France and Denmark have not really set up such a scheme. However, you can see that it's not because these countries do not have a specific setup that the banks have not provided from time to time these options to their borrowers. So of course, covered bonds are not ABSs, and they can cope with some payment holidays thanks to the other income received by the banks. But some figures start to be very impressive. So S&P mentioned that in average 17% of the loans within the UK covered bond pools were under payment holidays back in June. In Italy, we've seen ranges of payment holidays between 5 to more than 20% between the different covered bonds or RMBS programs. In Spain, it's from 2 to 10%, and even in France, it can go up to 12% despite the lack of legislation. So the figures are quite high, according to me, and it may lead to some concerns for the investors. But, however, one thing which is very important is first that for the time being, the schemes are limited in time. So it's 3 months, 6 months, maybe longer in some countries, but it's supposed to be limited in times. And in addition, the issuers will have to keep paying the coupon on the covered bonds, have to respect the liquidity ratios, and even more important, the OC. So that's definitely something completely mitigating the problems. In addition, in some programs, you can see a high level of payment holiday utilization, but the asset coverage test calculation will discount the payment holiday, or in some others, it would be completely being pushed out of the cover pool. So overall, I'm not that worried about the direct impact of payment holidays. For me, the real point of attention for the investors should be to monitor the transition from payment holiday status to either performing or in arrears. And that's where the payment holiday level might be a good leading indicator of futures default. But you really have to monitor this transition. We don't have yet enough time to look at this properly, but that's what you will have to monitor in the coming months when we have the information. So overall, not a big deal. Of course, the second issue is much more of a problem with the unemployment and defaults, but I won't debate about that. That's a standard one we have with any kind of recession. So at the end of the day, unemployment will be the key on residential mortgages, and payment holidays might be a good leading indicator, but is not a direct threat. On commercial mortgages, the issues are very different. We're talking about far less granular pool with concentration in some specific sectors, which are mainly under attack by the COVID-19 for most of them. So if you look at hotels, it's a very small part most of the time of the commercial mortgages, but you know that, well, that's the worst crisis in tourism ever. So that's definitely an issue. When you look at shopping centers, retail parks, well, they were already under pressure due to the constant increase in online shopping, and the crisis has accelerated the transformation, while increasing at the same time the sanitary cost for the retailers. So you will have a pressure on rents, especially since most of the time they are linked to the turnover. So that's an issue as well. For office rents, well, they will not feel immediately the pressure, but working from home, as we have experienced, may lead to cut investment in offices. So for these three types of commercial mortgages, you know that there is a big threat specific to the COVID-19 and not only due to the recession. Of course, on the other side, you have warehouses, logistics, or multifamily mortgages where they will either benefit or will not be that much at risk. So overall, the focus on the COVID crisis specific impact has been mainly on payment moratoria for the time being for residential mortgages, but our view is that it's much more an issue for the commercial mortgages, and especially when they are backed by retail parks, shopping centers, hotels, and offices.
Thank you. Arnaud-Guilhem, I get your point about these moratoria being limited in time and the importance of looking at the transition. What about in the longer term? Look, this concept has been invented. We can't uninvent payment moratoriums. What about the possibility of seeing a new wave of payment moratoriums as a result of a second wave of the epidemic? Or, we're in an increasingly debtor-friendly environment, new moratoriums for other kinds of exogenous shocks or even idiosyncratic shocks for an individual. Does the long-term implication, the long-term effect of having these moratoriums, does that concern you?
That's definitely a concern for ABS or RMBS, because here you don't have any protection, and the fact that you don't have the interest payments may lead to direct losses to the junior tranches or even to the mezzanine or higher. For covered bonds, that's where you're very happy to have the dual recourse on both the bank and the cover pool. And well, I would potentially expect the government to push for longer-term payment moratoria or on other asset classes. But at the end of the day, they will try not to have to buy in or even potentially buy out at another stage the banks, and that's where it's very important for us to have this dual recourse for covered bonds. Yes, it will be an issue for the income of the banks, it will be an issue for the income of the cover pool, but I expect the government not to push the payment moratoria too far, otherwise they will be in trouble with the banks in their own country, and I guess that's definitely not what they want to do.
But then the question I have is, would they be in trouble with banks, but how about they will be in trouble with people and citizens, right? And I think that's where you have to strike a balance in that regards. And that's something we just don't know whether there will be a second wave. But I think it was an important development in the cover bond world, the moratorium. And now we are aware that something like that may be introduced in the future. And it may have an impact about how the markets develop, looking into also emerging markets.
Yeah, well, I fully agree on this, if I may, Richard. I fully agree on this, but the fact that you have the deposits lying within the banks as well and not being secured by the cover pool leads me to have less concern than definitely on ABS and RMBS. That's something you have to put into your analysis and that you have to price differently.
David, if I can turn to you now. One of the big things which is going on behind the scenes in this crisis is credit lines between the different central banks and the Fed extending credit lines in response to the dollar shortage. Now, clearly the basis swap between euros and dollars is a massive determinant of whether European issuers are going to make the trip or the virtual trip over to America to try to sell covered bonds backed by euro assets into dollars. A lot of European issuers are going to be watching this video. From the perspective of a non-European investor in covered bonds, what would you like to see more of from the covered bond market?
So, I think you can kind of broadly break down what U.S. investors would like to see into three general categories. And actually, we've already touched on at least one of the categories. I'm going to start with the E one, and that is there's simply not enough covered bonds. I mean, if you look at what happened last month, I think we had, one issue? That's the lowest since 2009. So there is a global imbalance of credit investors or capital to invest in fixed income and fixed income assets. And it's no more evident than in the covered bond market. You're looking at estimates for the full year to be maybe close to 100, which we haven't seen in ages. And this is just it's a technical, and there's reasons for it. So it has to do with bank balance sheets. Actually, there were more capital being issued by banks, AT1 securities and lower tier securities. Some of that has to do with potential inclusion in a capital calculation by banks and a preference for issuing those capital securities. But at the end of the day, the senior preferred and non-preferred funding for these financial institutions are pretty much back to pre-pandemic levels. And, it's just banks, I think, probably feel like they have a comfortable amount of capital exposed into the covered market, and probably want to continue to utilize their preferred and non-preferred funding, as well as their filling up their capital buckets. The second one is probably a global problem, and that is investors want to see more return. Look at the current pricing and current returns offered. And I know this isn't something new or shocking to anyone that's going to hear this or on the panel. There's just very little return to be had in the covered bonds issued by European institutions, or even across the globe. You can look even outside of the Eurozone and some of the other areas. It's just a very modest amount of return we've had over the last, arguably, in a hyper way in the last 6 months. We've had severe financial repression by global central banks, and they've taken away return from the market, and those securities that had more risk have outperformed those securities that have had less risk. And as we all know, covered bonds are on the less risk part of the spectrum, and so there's not a lot of return. So not a lot of supply, not a lot of return. And then the last one we've touched on in a couple of different ways already, but that is the financial systems. And this is a broad comment, and I've looked at the European banks, the U.S. banks, emerging market banks, and I think the same can be said of a financial institution, whether it's here in New York or headquartered here in New York or somewhere in Europe or Asia, Canada, or wherever. There's a big question mark as to the ultimate impact the pandemic, the quarantine, and the economic contraction will have on these balance sheets. And when you look at price to book ratios, I mean, if there's one ratio as an analyst, you kind of often have to narrow things down and just say, okay, what is the one thing you're going to look at? Look at the price to book values on some of the financial institutions, and they're quite low. And what does that mean? Well, it's that there's uncertainty as to, I think it means there's uncertainty as to the asset value of that institution. And you'll find that banks globally have low price to book values, and in particular, European banks have low price to book values. And part of it has to do with the market model and the business model of European financials, but also it is the uncertainty. And, the U.S. bank CEOs have talked about this in the last quarterly conference call in particular, that, they don't know what's going to happen. It all depends on how much continued support the central monetary authorities globally have and are willing to deploy, how it's tapered, how quickly, and how persistent the problem is. Is it something that is dealt with in the next 3 months with vaccine, widely deployed, things are back to normal, or is this something that we'll be talking about 2 or 3 years from now? Because those scenarios have very, very meaningful differences for financial institutions. So I'll stop there. Do you have any other questions? I know it was a long answer to your question, I guess.
Well, I've got loads of questions I could ask. I think I'm going to limit myself to one, though. And on the topic of return, sure, it's no surprise, we'd like more return on covered bonds.
Yeah.
But the covered bond market is predominantly negative yielding at the moment. And in Europe, that works just fine because it may be negative yielding, but other risk-free assets, shall we say, such as German government bonds, are even more negative yielding, and you have to own them for a lot of structural reasons. Covered bonds you have to own for liquidity buffers for banks, for whatever. I'm guessing at the moment it will be impossible to ever have a negative yielding dollar-denominated covered bond. Are there any circumstances? Are there any regulatory changes? Is there any way that could be the case, and we could take away the zero lower band in the dollar market?
I think we are only limited by our imagination at this point. So I think zero is a concept that mathematicians figured out, a while ago, but I think it's arbitrary. And to answer your question, yes, I think you already have negative real yields on some corporate debt. It's not hard to see how, depending on how, like I said, depending on how the situation persists, you could, in particular, that I think is a driving factor here. You could see yields go lower, go negative, and right now the corporate index in the U.S. Returns about 2%, and I never thought I would ever see it at that level, but frankly, it's been through that in the last few weeks, and there's no reason to believe that the longer term trends that have been going on for the last 50, 60 years there's no reason to believe they're not going to continue to persist.
Mm-hmm. Before I turn to Jacek to talk about Central and Eastern Europe, can I just ask everybody one big follow-up question about credit? Look, when we had the global financial crisis 12 years ago, we learned a lot about covered bonds and credit, and most of it was pretty favorable and has been defining the market ever since. 5 years from now, big question, what do you think the lessons are going to be about how covered bonds cope with the COVID crisis from a credit perspective? Anyone want to take a first stab at that?
On my side, I think we'll learn that pass-through covered bonds may lead to pass-through amortization. So I think that's the worst scenario for me would be this scenario. Mm-hmm. That 5 years from now, we learn that, well, you may not be redeemed at the maturity date as expected. But that would be really the more or less the worst case scenario I would see for covered bonds. That's not the base case scenario, fortunately.
Mm-hmm. Any other thoughts on that?
I would say that when we look back 5 years from now, I think we will probably see that what we thought was expensive is cheap. And I could have said that 5 years ago too. So that's what I think.
Excellent, good answer. Jacek, can I turn to you? And clearly one of the implications, I know you believe, one of the implications of all of this is a renewed focus on covered bonds in some new exciting countries. So can you tell me why you believe that, what the effects of COVID is going to be? what's happening in the countries that you cover.
Absolutely. Good afternoon, everyone who's watching us, and big good afternoon to all the co-panelists. Clearly, we are the last panel of the day because the light behind me is switched on. That means we've been having a hardworking day on this conference. And you asked a very interesting question. I think David alluded to the point a bit, because we are, in my view, during this pandemic at a really turning point. We spent, starting from March, going to midsummer, a lot of time in terms of saving lives and people and human lives. And now when the economy, especially in Europe, is opening up, we are turning our eyes into how we can save our economy, which was used to finance all of the work that was happening and the economic stimulus throughout the spring and then going to summer. And I think one element that COVID has demonstrated for us a lot for the emerging markets, including Central Eastern Europe, is the need for the robust local currency market development, and that local currency market should be really as bulletproof as possible towards shocks. And that's not a new lesson in a way, because that was exactly back in financial crisis where the focus on capital markets in emerging economies has increased because of that. Obviously, there will be a lot of economic expenses, and a lot of money will have to be channeled to the economy. And that obviously is very often taken by the banking sector. But this may not be enough this time around, where capital market can play the role. And then who can help with that, in my view, is also looking towards the central banks and the monetary policy, and having cover bonds as a collateral for monetary policy operations, having cover bonds also as an element of some kind of a special central bank facilities that we can see, because this instrument has been tested and has been performing quite well. We discussed a lot the payment holidays, and I think that's one of the elements that can impact the development, and obviously the economic turn down in terms of affordability of mortgages, and whether actually people will be buying real estate and taking a mortgage. And on the other hand, will banks be lending money so easily? That may have another impact on that. And you mentioned the negative yielding of cover bonds, and you made reference also to Germany and other established markets, which is not really yet a case in Central Eastern Europe. And even though the first 8-9 months of 2020 hasn't been great in terms of cover bond development in Central Eastern Europe, we shouldn't forget about a couple of examples that are worth mentioning here. And I think two of them are coming from one of the smallest jurisdictions in the European Union, but how brave and how well developing in that regards, which is from Estonia. We saw a one benchmark, Euro benchmark issue coming out of Luminor, and sub benchmark from LHV. We also saw Slovakia VUB coming with a benchmark Euro issuance to the market. So things are developing. Whether we're going to have a growth like we had last year and the year before, looking, for example, like Poland, probably not. But hopefully this may pick up a little bit towards the end of this year, and then certainly in 2021. However, what I see really interesting at the moment, what is happening, is on the reform side. And that helps with what we discussed in terms of the COVID-19, the work of central banks, the monetary policy, and all the measures that are being in place. But also it comes along with the directive on cover bonds, which is to be implemented by 2021. And the countries that we were working on in the past, for example, Croatia, are now really waking up saying, oh, let's restart the reform, because it's A, good to have this instrument just in case, but B, we have to now comply with the directive. So we just restarted the work in Croatia, and the working group has been set up by the Ministry of Finance, who will be part of it. We are doing a project, a reform project, which started during the COVID-19. So it's quite exciting because everything has been online so far in Bulgaria. So we haven't had any physical meeting in Sofia, but we're progressing in Bulgaria on creating the cover bond legislation, because there is a potential for this market to further develop. I mentioned Estonia, but again, similar in Latvia, the focus now is really to finalize the legislation this year, because the government sees the benefit of it. And then secondly, what I think is quite relevant is that this is happening at the EU, and you mentioned, Richard, Central Eastern Europe. But I think we are starting, or maybe we are, but we should be even more open-minded for covered bonds for non-EU jurisdictions. And we've just spoken to a central bank of a country outside the EU that is looking at those developments and is looking at the directive and actually want to set up this instrument as a part of a financing for banks and for the economy and for mortgages, but also as a way for a monetary policy operation, because again, we are hearing the word crisis a little bit. We heard that 12 years ago, and that's where we also heard so much the word cover bonds, or two words, yeah? So again, I think there is a bit of a future, and maybe I'll finish this at something else, because you ask, oh, how are we going to look at it in 5 years' time? And my thinking is, oh, will in 5 years' time cover bond be just backed by mortgages, or are we actually going to have also a European secured note? Will we use this structure that we have at the moment to have other asset classes like loans to small and medium-sized enterprises, because of elements we mentioned earlier, that the mortgage market may not really develop as quickly as we would like to see it, and we would have to have different assets also in this instrument, which could be branded differently, but use the same technique. And then the question also comes about sustainability. But I'm going to stop here, Richard. Thank you.
Thanks, Jacek. I am just going to have to correct you on one point there about the Bulgarian project, that there was a physical meeting. I went to it, but you were too scared to.
I was not too scared. I was not allowed to by the bank policy back then. But yeah, we were all in lockdown a week later. But I get your point.
on a more serious note, that's probably the longest you've ever gone without talking about green or sustainability factors. And I think clearly this time last year, green cover bonds were the key topic. Has it been parked? Has it irrevocably changed? Is it now a different priority?
No, and I'm glad you mentioned that. And I also didn't talk at all about innovation and financial technology, but let's leave it for another conference where we can really go to the beach in Barcelona and talk about it. But yes, green and sustainability in general, which means, not only green, but also social elements. And clearly we see, last year the green cover bond and actually a green bond market was growing rapidly. If you look at the green bonds, it was 250 new issuers coming to the market last year, which we haven't seen such increase ever in many of the markets. And obviously we saw some green cover bonds coming out of our region, including Poland, which we also invested, and we're very, very proud to do that. However, this year probably we see a bit of less green bond activity, but it doesn't mean that this is parked. I think this agenda on sustainability will be increasing and will be becoming new normal, in my view. We see it from different clients, not only on cover bonds, but actually on other financial instruments. But we see also a pickup, which is quite interesting, on social. So at the moment, I think in the last 3 months, we see a lot on social bonds, a lot of discussion, a lot of looking into ICMA social bond principles, and what really generate that and how you structure it. And I think that could be one of the elements that we could see also in the cover bond side. But I think the green will really come once we know a bit more how and where and when the world is moving. It will come again to the top of the agenda. We have a lot of also policy work at the moment on green bonds and green capital markets in many of the Central Eastern European countries with support with the European Commission. We know how sustainability and green and EU Green Deal is on the top of the agenda. We also made a statement as a bank in the mid of pandemic that by 2025, we're going to become a majority green bank. That means that over 50% of our investments will be in green and sustainable. And imagine that the countries we work, 38, are not the leaders in that. So we'll have to make sure that we are creating the right policy actions for issuers and companies to be able to tap into the green market and for us to also invest. So I think we just stopped a little bit at the traffic light because maybe the light was orange, but now we are slowly, switching to the first gear and accelerating and starting to drive farther away because we see the green light coming. And I will finish here then.
That's more like you, Jacek, talking about green again. Thank you very much. And thank you, everybody. So if I can turn now to you, Morten. So, Morten, So far on this panel, we've been very focused on the euro market, as usual, probably too focused as the covered bond market. And there's always this story about the Nordic currency markets being much more resilient and independent from shocks that affect the euro market, like there was last crisis. Is it the same in terms of the resilience this time? How have the markets stood up?
Well, thank you, Richard. I'm very happy to answer that question. Yeah, to start off, I would actually, as you point out, I would like to sort of not look ahead, but actually look back on the Nordic covered bonds and how Nordic covered bonds were impacted by COVID-19 when it hit financial markets, back in March. And then I would also just briefly like to address and highlight central bank measures that were put in place in the respective Nordic countries. And then lastly, also share my perspective on the outlook of what lies ahead in terms of supply, demand, and what I believe will be the future market themes, so to speak. Nordea is an issue of covered bonds in all the 4 home markets: Denmark, Norway, Sweden, and Finland. This means that we issue euro covered bonds from the Finnish mortgage company, Nordea Mortgage Bank. But in this short run through, I will not focus on euro covered bonds, but only on Nordic covered bond issuance in Scandinavian currencies. For Nordea, Nordic domestic covered bonds amounts for half of Nordea's wholesale issuance, and therefore it's a significant and absolutely vital part of Nordea's funding. And as you pointed out, Richard, the Nordic covered bonds markets have been here for decades, and also during this crisis. Once again, it has been comforting to see the resilience and strength of the Nordic covered bond markets, I think demonstrated by two-way secondary pricing, by a very quick reopening for new issuance far earlier than issuance in international markets. And I think it boils a little bit down to the tap issuance system that we have in the Nordic countries, which allows for smaller size issuance with less execution risk, as you only have to go out in smaller sizes. But if we look at a little bit closer on Denmark, we have this very well-known balance principle or match funding setup, which implies that we actually come to the market with tap auctions on a daily basis. And it entails that you daily take the temperature of sort of risk appetite in the market during the day, both in strong and not so strong markets. And if you look at the graph on the screen, it's clear to see there were days where with some extreme spread widenings. However, the market managed well and allows us to tap issue on a daily basis throughout the entire crisis. And as you can see, spreads have retraced to levels before COVID-19. If we quickly turn to Sweden, the Swedish central bank, Riksbanken, responded early and prompt in the form of QE in covered bonds and TLTRO-like facilities for lenders. I think it's clear that this dedicated and proactive support from Riksbanken helped the Swedish covered bond market normalize impressively quick. But even before the QE support was introduced from Riksbanken, I think the market showed signs of a quick recovery. But it demonstrates to me at least, the systemic importance of the Swedish covered bond market in the eyes of Riksbanken. And in Sweden, we see now spreads from the graph also that are tighter than pre-corona. And I think the market is now looking for signs or signals from Riksbanken as to when QE can be scaled down. If we take a quick glance on Norway as well, also there, quick central bank action from Norges Bank, putting in measures to support liquidity and offer long-term funding. Norwegian covered bond market is less seasoned compared to Swedish krona and Danish krona, but also in Norway, market functionality and spreads have retraced and normalized quickly. In Norway, Norges Bank seem eager to pull away from supportive measures now and sort of to normalize its role in funding markets quickly. If we then turn to the sort of outlook for Nordic covered bond markets, I am honestly positive, and not only because I have to be given my role, but also because we have yet again seen impressive strength and functionality in stress times. And I believe in times like these with subdued growth and rising unemployment, I think Nordic cover pools should be relatively quite attractive. And if we look at early indications on collateral values, we see housing markets remain solid, so no concerns from on collateral values. If we look at repayment capacity, I think the social security system in the Nordics is second to none, and it basically allows for people to continue to service their mortgage even if they would lose their job. And I think factors like this and elements like this will be something that investors will scrutinize in the years to come. And I think Nordic pools, cover pools, will come out relatively strong here, also given sort of relatively low average LTVs. And if we lastly look at looking forward in terms of supply, we will have a euro covered bond market, in my opinion, where we'll have that will be dampened by the very large TLTRO take-up. And in Sweden, we have a sort of similar measure from Riksbanken, but amounts here are smaller, also in relative terms. So all else equal, yes, we should see dampened second cover supply. But otherwise, I think supply in Nordic cover bonds will remain at what I call normal volumes. And in turn, given potentially expected lower euro supply, one could expect sort of and hope for traditional euro investors to look at Nordic cover bonds in search for high quality offering a pickup. That given if FX swap or cross currency would work, I would expect more foreign investors to take a close look at Swedish, Norwegian kroner and Danish kroner in covered bonds. And I think I've spent my time here, so I will pause now.
Thank you, Morten. It's a very positive picture. I expected nothing less. Clearly, it's a very nice environment. But you said you weren't going to focus on your Finnish issuance in euros, but I'm going to have to pick you up on that. With TLTRO, with the asset purchase program, we've got incredibly benign conditions in the euro market. We've always had a little bit of I was going to say Nordic, I suppose I should say Scandi issuance into the euro market. On balance, we can see more or less now coming from Scandi issues into euros.
Yeah, I think that's a super good question. And I think in the setup we have in Nordea, we have this, as mentioned, we have a dedicated mortgage company each country, and we have our euro issuance out of the eurozone in Finland. But if we look at our peer issuers in the Scandi currencies, I think looking at the strength of the cover pools and looking at sort of the I would expect lower issues in euros. I think we will see more peers coming into the euro market. Also, what we've seen before with the ECB's purchasing programs, it's sort of also non-eligible Scandi issuance will grow because spreads will also be drawn down on the non-eligible part. So yes, but again it comes down to what are the swap costs here? What is sort of where is the basis swap? How does it actually come in? But if that would work, I would see scope for like Nordic issuers coming into the euro market if the basis swap works and take opportunistic funding there. I definitely see that coming, sort of filling a little bit of that supply gap.
Okay, thank you. And Boudewijn, turn to you last but not least. Thank you very much for joining us. In your role as chairman of the ECBC, it must have been quite interesting. There must have been quite a lot going on from Brussels. Can you just run us through what the ECBC has been doing and my own particular favourite interest, particularly on the topic of alternative asset classes for covered bonds?
Yeah, pleasure. Yeah, so it has been an interesting year or period, especially because the ECBC as an association, they try to be close to the members, which has been very difficult in the current environment with everybody working from home and no physical meetings, no conferences. But very quickly, what we did and what we continue to do following the COVID outbreak, and you can see that on the slides. So on the first slide is basically is setting up a joint task force. So a joint meaning for the European Mortgage Federation as well as the European Government Council, looking at how on the short term we could provide added value and information and sort of a think tank, and where all the information would be centrally available for members in terms of what is the impact of COVID on the markets, on the economies, and what kind of actions are being taken in the different markets. So there was a short-term sort of horizon and a medium long-term horizon, and the first one, the short-term, was to compare and get the information from the members in terms of the different measures taken in different countries, and also get some statistics on how many payment holidays, what kind of payment holidays, what are the actions governments are taking. And in terms of how can we share best practices, how can we work maybe together with the European Commission as well as other entities in Brussels to have a dialogue and to help them find a solution, to help on a recovery plan. So that was the plan there. This task force came together or had calls on a weekly basis, a bit less in the last months during the summer, but we are activating it now. So that was the first answer. If you can go to the next slide, slide 3. It basically shows you, so we had weekly meetings of a dedicated task force with representatives from all members and especially from the different countries to exchange on views. We had also some extra special board meetings to see what needs to be done. And also what we also did, and that was the ongoing aim to work on transparency with the template, the harmonized transparency template, to add additional information on payment holidays, so on COVID-19 affected loans in cover bond programs in the different countries. So we agreed on an additional template, which is voluntary, but which will be probably widely used in terms of how many COVID loans will be in pools and how they are treated in the various pools. So that's what we did at that point in time. In terms of the deliverables, what the task force did as well is agreeing on key priorities on funding and lending, what needs to be done, what is important for the various countries, and also various discussions. That's the next step, is basically discussions with the European Commission, with other entities, to see how we can help by maybe exchanging on the knowledge we have on cover bonds and techniques and funding with recourse, to see how we can help to help the recovery. At the moment, it's government and countries putting in place subsidies and short-term measures, but on the long term, this funding needs to be replaced by funding coming from the market, capital markets. So that was the next step. And if you then go to the slide on the the COVID task force, they see how many jurisdictions participated. Also very comparable that many countries put in place state guarantee schemes, which need to be replaced by private funding schemes afterwards. I think then the next one is, which is probably of interest for you, Richard, as well, is the European secured notes. On the one hand, cover bonds is the core of the ECBC, funding backed by mortgages and public sector assets. But a discussion that has been ongoing for quite some time now is European secured notes. So also provide funding with recourse to SME loans and potentially with a green angle, and that's links in with the energy efficient mortgage and green and cover the label, which the ECB is very active on as well. And the latest developments there, we had basically a new sort of round table with the European Commission, banks and insurance companies took place. But if you look at purely at the European secured notes, so the latest developments, so slide 8 in the pack. So the task force had met again on the 9th of July to see what could be done and to see what kind of work streams could be put in place. And there has been identified 3 work streams, one on eligibility criteria, so what kind of SME loans, what kind of assets could be used. Second one, what's the business case for ESN? What needs to be done? What needs to be put in place to make it work? And the third one is the structural aspects in different countries, because in the end, SME loans are different in countries, and the legal structures are different, and especially also in terms of transparency requirements and assets. What kind of transparency could help the product to make a success? And that's probably will be. A next meeting be held, and further information will be discussed further in the has been discussed in the steering committee and in the task force. So the next step is a sort of virtual meeting between the ECBC Secretariat, between the chairman or the new chairman of the European Secured Notes Task Force, and also the European Commission, who has recently said they continue to be very interested and would like to follow this initiative very closely. So in that sense, twofold. The COVID task force has been a success on the short term. It continues. We will have further meetings to see how we can add and help on the longer term, and what needs to be done and how frequent. And the European Secured Notes is one of the initiatives we support, besides the traditional cover bonds, just to help and see how we can maybe use those assets to provide funding instruments for those countries and those members that would need it, because not everybody needs this. So it would maybe leave it there as a response what the ECBC did in the past couple of months on these topics.
Thanks, Boudewijn. That's very reassuring. I know there's been a great response, and I know that everyone in the ECBC has been working very hard on these topics, which is very reassuring. Gentlemen, can I ask you one final question, both of you, either of you? This time last year, we were talking a lot about the directive, about the transposition of it into national law. Very, very briefly, are there any particular sticking points, problems, any pain points in the transposition, or is everything still going ahead as per plan?
I would be happy to.
Yeah, start. Go ahead.
Oh, okay, thank you. No, I think in general, I think there is a risk that you sort of put it too far back in your mindset when you have COVID-19 and everything, but I think in the Nordic associations and the work on the sort of national implementation, I think it's moving ahead quite well. We also have some, to say at least, very active associations in the north here, so it's moving along. I think the major sort of, I would not say pain point, but the major sort of hurdle to get around is obviously the 180-day liquidity rule and the sort of the interconnected with a soft bullet structure. I think that is what most issuers are sort of looking at and sort of seeing how do we grasp that? What is the outcome here?
Yeah, I would agree that in terms of the pinpoints overall, I don't see major issues in terms of implementation. There are, of course, as soon as you go into details, there might be different potential ways for interpretation, and that's where the discussion is between how it's put in place in different countries and the questions that may come up. And one is on the 180 days liquidity. The other one is on the extension and what kind of triggers for extension in case of soft bullets. So there are a few of those points. Overall, I think people in general agree on the way to put it in place. And I think it's also a matter of to what extent do you put those details in the law, or to what extent you keep it relatively flexible and leave it more for a regulator to or secondary legislation? But that's an ongoing discussion. I think in some countries there has been more focused than in others in terms of progress. And I think also in terms of progress, some of the countries there has been a bit of delay, I think, in terms of implementation, mainly due to more urgent topics in terms of COVID-related topics. So in that respect, we have to see if everybody will have the time to put this in place within the period set. But it may be that there will be that some countries need some more time to implement this.
Thank you both for those comments, and thank you overall for your comments today and for joining us. I think it's nice to end on a topic that isn't COVID. This panel, this conference has been 90% the implications of the crisis and all of that bad stuff, and it's been entirely virtual. We look back a year. We were talking about the directive, we were talking about green, we were talking about sustainable, we were talking about new jurisdictions, we were enjoying Bavarian hospitality. So let's just hope we won't be speaking about COVID a year from now. Let's hope that we will be meeting for real. Until then, thank you very much for joining us. The relationship between the credit of covered bonds and the COVID epidemic is a multifaceted one. We've already heard Arnaud-Guilhem's comments on the credit risk of the underlying assets and Edward's on the impact of the new monetary environment. But one of the key linkages, and one of the more difficult ones to fully understand, is that between the epidemic and sovereign credit, and then the linkage from sovereign credit to covered bond credit. I'm joined now by Covadonga Aybar of DBRS Morningstar. Thanks very much for joining us today. Could you please tell us how you view the sovereign covered bond rating linkage in the light of the COVID pandemic?
Good day, and thank you for the kind invitation to be with you today. From DBRS Morningstar point of view, we believe that the covered bond loan rating stability will depend on the severity and length of the economic slowdown in each country, being the size of the potential impact highly dependent on the sovereign response to the pandemic, the endurance of the national economies, and the strength of the financial systems. At the beginning, government policy measures, including limitation on movement. Then in early May, we saw how the main economies gradually eased restrictions on economic activity, and currently, countries keep on maintaining social distancing and government economic support measures to individuals and businesses. All this on top of other emergency financial plans, support plans at the European level. Government relief measures vary among countries, and we have been closely monitoring them. It is true that the measures could potentially alter the flow of cash in a covered bond program. However, we believe that the deterioration of the pools could be a potential source of risk under a prolonged stress scenario. However, the covered pools are a secondary source of payments. So we believe that in the short term, the dual recourse nature of the covered bonds will help. On April 2016, our sovereign team published our macro scenarios for the period 2020-2022. And these scenarios were last updated in July 22nd. So here in this table, you can see the ratings of our main economies, and also our moderate scenario, that is the one embedded in our covered bond analysis. The moderate scenario remains somewhat optimistic in terms of recovery during the second half of 2020. It is still relatively cautious with regards of growth in 2021. And our sovereign team believes that in order to see 2019 outputs, we will need to wait at least until 2022. So the key question here would be how the sovereign may affect the covered bonds. So changes in a sovereign rating could have an indirect impact on a covered bond rating. because they can apply or they can have an effect on different covered bond rating pillars. I'm going to start talking about the covered bond attachment point, which is our starting point under our analysis. It expresses the strength of the reference entity as a source of payment. It is composed by the reference entity rating and a notch and a cliff depending on the entity's applicable resolution rating. The deterioration of a sovereign can imply a more challenging operating environment, affecting the reference entity rating and therefore the covered bond attachment point of a given program. Let's talk about now the legal and structural framework assessment. It expresses the potential linkage between issuer and the program. It takes into account several pieces like covered pool segregation, timely access to the covered pool cash flows, the contingency plan, and supervision. Except for pass-through programs, the considerations about support can overcome the structural features of a program under our analysis. So the LSF assessment tends to be less favorable when the rating migrates down the scale. Now, I'm going to talk about quality and the likelihood of support being forthcoming. We assess the stress scenario a program can withstand with a given level of OC. When a sovereign deteriorates, the asset quality may deteriorate and the volatility of the financial markets could increase. As a consequence, the credit asset analysis and the market value spreads taken into account in our cash flow analysis may be subject to change, rising the level of OC needed to withstand a given rating. Lastly, I would like to talk about public sector programs. So public sector covered bonds with high concentration in a single sovereign are more likely to be impacted. According to our methodology, when we have covered pool exposures in a whole sovereign of 20%, we apply higher stresses. Therefore, if we see a public covered pool largely concentrated in a single sovereign, the downgrade of the sovereign may put downward pressure in that program. From DBRS Morningstar, we haven't seen any rating downgrades in the covered bond jurisdictions. We believe that the key in the short to medium term is going to be the issuer quality, and we will keep on monitoring all the areas.
Thank you very much, Covadonga, and thank you to all of our speakers today. We've touched on a lot of topics, obviously mainly to do with the COVID epidemic. As Toby said in his introductory remarks earlier today, covered bonds are good in a crisis, but only because of their ability to adapt to the changing needs of society. Understanding the multifaceted implications of this epidemic, whether they be related to covered pool credit, to technical factors, or to the structure of market, is essential. Hopefully this time next year we can meet again in person and reflect on how covered bonds successfully dealt with the crisis. We're now going to open a chat room to discuss the topics that we've covered here today and to let you ask the questions that normally you'd be able to ask in person. Please join in with that conversation, and thank you very much for watching.